Hi, this is Fred Sroka with Golden Gate University. Today is November 17, 2017. Yesterday, not only the House of Representatives, but also the Senate Finance Committee both passed the new H.R. 1 provisions. They're competing versions of tax reform for the United States. We don't pretend to provide a complete summary of all of the provisions. To be honest, it's over 700 pages, and I've lost a lot of sleep reading versions that have gone out of date. The purpose of this short slide deck is to discuss things that we might want to have a decision made before the end of the year. What can we advise our individual clients they should be thinking about in a time of uncertainty, where we're confident about the House passage, but we're unsure about Senate passage, and more importantly, we're unsure whether anything will come out of conference between House and Senate versions. Let's begin by taking a look at what the proposals are. This is dealing with individuals, so you'll notice there is no great savings in terms of tax rates. In fact, the proposed tax rates from the House are virtually the same, except perhaps for an extra $30,000 or so at the lower 28% rate. As we take a look, and a little bit at the 39.6% rate, the Senate actually knocks 1% off for incomes over 1% and gives another 100 grand or so at the what I call the middle income rate. Well, if we don't see a drop in rates, how are we saving any taxes? The answer is that both proposals seek to dramatically increase the standard deduction. In theory, this isn't bad, right? What we're doing is we're simplifying things, getting rid of a lot of paperwork, a lot of line items. When you knock out the personal exemptions also, though, if you have a husband, wife, and only one kid, you've got to ask the question, will my particular client actually be ahead or behind as a result of these changes? There is one nice thing, which is elimination of a lot of the complexities associated with the alternative minimum tax. And the House proposal at least discusses giving refunds of any AMT carry-forwards over the next several years. That's nice, but I don't see any real dramatic planning associated with it. Moving on to the business income that individuals pick up, this is where the tax law will change dramatically. Let's frame it first of all. The Republican agenda was to dramatically drop U.S. corporate tax rates. Both Republicans and Democrats were actually in favor of this. Charles Rangel, probably the most liberal of all the Democrats, was actually supportive of a drop in corporate tax rates a number of years ago. The problem is the small business lobby saying there's no way that we want Home Depot to have a lower tax rate than all of our individually owned Ace Hardware stores. That's what put the pressure on the Congress to try to drop tax on business income. As a theoretical item, that's wonderful. We've always seen business income get severely punished, despite the fact that Congress constantly talks about small business being the engine of growth. We've seen that investment income, whether it's dividends getting the lower tax rate like capital gains, even interest wasn't subjected to as many taxes, certainly not the self-employment tax, until the net investment income tax came along. So the idea of giving incentives for small businesses is wonderful. We don't know where it's going to wind up, but let's talk about the two competing proposals as they emerged from conference and from the House right now. The Senate has tried to give a deduction. It's an odd percentage, 17.4%, to get down to a better effective tax rate of income that gets reported as small business income. What that means is it either flows to the individual off their Schedule C or off of a Form K-1, whether that K-1 came from a partnership or came from an S corporation. When you take a look at the limitations, the Senate has said, let's have that only apply to domestic ordinary income. We don't want to shelter your offshore income that flows to you out of a branch or something. The interesting limit is if you're the person earning all that money, you're not going to get much of a deduction. Instead, the Senate has proposed to limit this 17.4% notional deduction to 50% of your W-2 wages. Curious definition that might include deferred compensation. The deduction also doesn't apply to reasonable compensation. If you've seen S-corps that have tried to have very low salaries to avoid the SE and NII tax in recent years. It's probably the same principle. You need to pay reasonable comp. You can't drop your comp down very, very low to try to increase this lower taxed amount. And then there's a broad range of professional services, including doctors, lawyers, accountants, engineers, and consultants, etc., that will be entitled to the benefit as long as they stay, I think, down below $150,000 a year of income. That benefit gets phased out as you get over $200,000. A few other changes. What the Senate is doing is saying, if you have your own business, the income flows directly to you, just a single layer of tax, however it gets there. And if you employ a bunch of people, great, we're going to try to give you a substantial reduction in the tax on that income. The House version is dramatically different. The House version says, let's just have a flat 25% maximum rate, again on the same type of income. Again, it only applies to ordinary income. As it stands right now, I do not believe that the House version limits that to domestic income. Similar to the Senate, it doesn't apply to anything you actually report as compensation or that you should report as compensation if you're paying yourself a little bit too low. Here's what's weird though. Where you both own a business and you work in the business, there are a series of rules as to how much of the income that you earn will qualify for the 25% rate. If you aren't active in the business at all, now this is set at the Section 469 passive loss 500-hour-a-year test, then go ahead and treat all of the income you get on your K-1 as being flow-through. My guess is they're going to wind up saying, however, you need to pay yourself reasonable comp for the 500 hours, but I did not see that in the draft. To the extent, however, you're active in the business, then most people will be able to automatically assume that 30% of all the income on their K-1 is going to be treated as eligible for this 25% rate. What that means is that we assume automatically that at least 30% of whatever you're getting on your K-1 is attributable to your ownership, not to your services. There's then a list of bad service providers. If you'll notice, doctors are no longer on the bad list according to the House, but lawyers, accountants, engineers, consultants, and of course artists, Congress has always hated artists, show up as having a 0% safe harbor rate. You can still prove that capital is an important factor, and you can simply stop working in your business. The House also tried to say there will be a special 9% rate. It comes up to maybe a $2,200 tax savings for most people. Probably not that important. However, there's a substantial chance that starting in 2018, we are going to see a dramatic change in how small businesses are taxed. Well, how do we pay for the huge corporate change not being discussed here and those individual changes? Now we go through the slash and burn portion of the proposals. With respect to the child tax credit, I believe that the House has said they'll increase it to $1,600. The Senate originally said $1,650. My guess is in the last 24 hours that got bumped up to $2,000. But you'll start to see things disappear, like credits for the elderly, for disability, for adoption, a bunch of other things. Tesla Motors is going to be frustrated at the electric vehicle credits wind up getting repealed. Education credits, gee, there was an article yesterday that said, boy, won't these things be good for education? When I analyzed it for the university, I came up with a better title of No Student Left Unharmed because of the dramatic cuts to support for education. But suffice to say, there are a number. If there's anything beneficial for students, it's if you don't pay off your student loan, it's still taxable to you, but if you died or you were disabled, then maybe we'll forgive it. And finally, virtually all forms of tuition assistance have been slashed. If we take a look at the Schedule A, rather than giving you a bullet point, please note that what we've done is we've highlighted in red where potential deduction gets completely eliminated, in yellow where it gets limited, and in green where it gets enhanced. The simple explanation is that not very much gets enhanced, maybe a little bit of what you give to charities. The largest issue is mortgage interest, where we're very concerned that, number one, the elimination of the second residence, so only principal residence. The home equity, the $100,000 that people have been able to deduct, seems to have been eliminated. And the Senate has proposed reducing acquisition indebtedness from $1 million to $500,000 maximum. This is going to have a severe impact, particularly in places where residences are very expensive, such as California. The high end of the market you'd think would be what's being targeted here, but actually, our son is trying to look at homes down in San Jose. He's just starting into his career, and I think the average home price might be $700,000 down in San Jose. So this is hitting the median home. That loss of the interest expense deduction is going to impact the residential market, at least in high value areas. I would imagine Boston, New York, the Bay Area, and probably other places in California. Charitable deductions, a very slight increase, and remember, with the elimination of the alternative minimum tax when we get to action items, that could be actually more favorable. Continuing on down, the itemized deductions subject to the 2% floor. Well, there's good news. It's that the P's limit, that 2% elimination of itemized deductions, got wiped out. But then you take a look at all the red on this schedule, and it really seems like that's because virtually all of the deductions have been eliminated as well. Even some of the above-the-line deductions seem to have been eliminated. So that's a copy of page 1 of the Form 1040. Again, it's easy to pull up your client's 2016 return, take a look, and explain to them what the potential impact is just by comparing line to line. We then get to the various exclusions from income. And again, these provisions are pretty much all anti-taxpayer. To the extent the employer has been providing housing, substantial limits have been put on the ability of the employee to receive that housing tax-free. If you sell your principal residence, you used to have to live in it, I believe, 2 of the last 5 years, and that's going to increase to 5 out of the last 8 years. More importantly, I believe the House version talks about phasing out that exclusion of gain to the extent that your AGI is too high. Employee achievement awards, we've been able to give those away without the employee paying tax. That's eliminated. Dependent care. Moving expense, think about trying to get someone to come to, again, a high cost of living area like California. We've always been able to provide fairly minimal transportation, some assistance with moving. Now, all of that has to be taxable to your employee. The deduction is disallowed otherwise at the employer level. And of course, adoption assistance, that's going to be taxable as well. In terms of pension and retirement, the changes aren't as dramatic. There was a funny rule under Roth IRAs where you could convert to a Roth, trigger all of the tax in your IRA or 401k, but then change your mind later on. That ability to opt out of Roth based on how the market performs has been eliminated, or will be eliminated if this legislation passes as draft. A little bit of easing on a few other items, and I just give you the basic headings right here. But know that in general, retirement provisions are somewhat similar. We should all keep in mind, though, that if we drop corporate tax rates and if we drop the business flow-through rates, there's less bang for your buck in a typical retirement plan. Now, while we are knocking out itemized deductions for things like medical expense and adoption, of course we need to give more money to the children of very wealthy taxpayers. So the estate and gift tax is designed, first of all, to double the amount that can escape any tax, up from $5 million per person to $10 million per person. I believe that still is with portability, meaning that if dad dies and he doesn't use up his $10 million, mom can give away up to $20 million. More importantly, the House proposal schedules to completely repeal the estate tax starting in 2024. But even though now daughter and son are going to be able to get $20 million without any tax, we don't want to bother them with the income tax that dad or mom owed on the property. So the 1014 step up in basis gets retained. Gift taxes fall somewhere in between. We will see a $10 million exemption if this passes, with a 35% tops tax rate. Again, I believe that's in the House version. I don't recall it in the Senate version. In the past week, while we've been discussing this, a variety of changes have come through. The investment management market, particularly venture capital, private equity, and hedge funds, have relied on what's called carried interest. That's where they get 20% of the gains out of the fund if things go well. It's been under attack ever since 2007. The proposal doesn't really convert it all to ordinary income. It just increases the holding period for long-term capital gains for the general partner or the members of the general partner from 1 year to 3 year. Not all that dramatic. Certainly for venture and PE clients that I worked with, you pretty much always had at least a 3 year holding period. It took that long to build up or fix up the companies that you acquired. Some minor modifications to the earned income tax credits, a variety of changes to stock options. Some of them were negative. There was a proposal that you had to pay tax as soon as you vested in your deferred comp. I believe the National Venture Capital Association quickly quashed that. Some of the proposals are positive, suggesting that you shouldn't pay tax until you can really get the money out of it. We don't know where that's going to come out. And if you've been following the press in the last few weeks, the Senate Finance Committee included repeal of the Affordable Care Act individual mandate. Who knows where that will go? Well, that's a brief summary of what's in play at the moment. The hard question is, what should we be talking to our clients about? It's easy to say that there will be many changes. For individuals, I suggest it's worth taking a look at last year's tax return and showing them which deductions might be challenged. If you know of any planning that's being done with income or exclusions from income, it might be worth having a conversation. Let's go through, though, businesses. If we believe that business income may have a lower tax rate next year, trying to defer income in that last month or so, not close major contracts, certainly seems worth considering. At worst, you wind up getting 1 year deferral. We don't expect tax rates to go up next year. And if tax rates drop dramatically, could be a substantial savings. While we don't have the expanded cost recovery deductions in this individual slide deck, if someone owns a business directly and they're thinking about making major acquisitions of tangible personal property, look to see if they're going to have to capitalize it. They might want to put off that purchase until January because there's very, very liberal write-off proposals over on the business side of this slide deck. You can listen to the business slide deck if you want to get those points. Finally, to the extent that the corporate tax rate does drop to 20% as proposed by both the House and Senate Finance, your client might want to consider whether they would rather leave the money in their business, being able to grow it at only a 20% tax rate rather than that 39% individual tax rate. You know, back when I started practice in the 1970s, virtually everyone lived in a C corporation. They kept their assets in there. That changed when Ronald Reagan dramatically changed the individual tax rates down from 70 to I think 28 was the lowest that they went. However, the likelihood that we may see a major shift in choice of entity is something worth considering. Here's what's scary. If your client does want to take advantage of it, they can elect to either check the box to make a C Corp or check and file a 2553 to be an S Corp. They can make that decision as late as March 15 of 2018, and it'll be effective as of January 1. I'd point out, however, that most tax preparers are a little busy in late February and early March. As a result, you might want to do some modeling well in advance of that. With respect to your principal residence, what can you do? Well, prepaying the second payment of property taxes. At worst, again, you get a quicker deduction. And if property taxes wind up not being deductible at all next year, as the Senate proposed, or limited to $10,000, as the House proposed, you might get a better benefit. Also, think about making that January mortgage payment a little early. My understanding is that because interest accrues in arrears, that'll increase the amount that shows up on the Form 1098. Might be a little bit of savings if your client would otherwise be limited. Can you accelerate a pending sale of a principal residence? Well, if this is going to hurt the high end of the market, more people, I think, will be inclined to sell with the limitations on the ability to use that $500,000 exclusion. Yeah, you might see people saying, I'd rather move forward. Can we actually close a transaction before the end of the year? The holiday time is a terrible time to even talk about trying to sell a house. In terms of itemized deductions, the ones that may expire, sure sounds like we want to talk about accelerating those, paying them before December 31. What's curious, though, is a few of them, for example, charitable contributions. I'd wonder if our client is in alternative minimum tax right now. They're only saving 28%. With the elimination of AMT next year, who knows, that charitable deduction might be worth more in 2018. It might actually be worth deferring those itemized deductions. Finally, we know that there's tremendous uncertainty. The fact that the Congress was unable to pass any other substantial legislation in 2017 leads me to be a little cynical about its ability to act here. On the other hand, JP Morgan knows a lot more than I do, and they just dramatically increased their estimate of how likely this legislation is to pass. Anytime our clients need to act now in a time of uncertainty, you can say, think carefully, model, be prepared, but probably avoid any major decisions unless you see a clear economic benefit along with the tax savings. Hopefully this has been helpful. If you do have thoughts on what we should be sharing with our alumni, with our adjunct faculty, and with our students on the pending legislation, please feel free to give me a call. My email's right on the front of the deck. Thank you.